2 points to consider when it comes to debt and inflation. And I want to share with you the fact that there is a lot of propaganda out there. So pay close attention on how inflation steals wealth. Hi, this is Justin Hitt with Sustainable Wealth Secrets. I'm on the Federal Reserve Bank of St. Louis's website, and they're talking about how the Federal Reserve monetizes the national debt. So literally, the Federal Reserve is buying U.S. debt. So they're buying U.S. treasuries, and sometimes they'll buy securities and other assets in order to, quote, monetize debt. Now, this particular article, from an economic perspective, it shows how the Federal Reserve is an independent entity in relationship to the U.S. government, because they can not only print money, but they can buy the debt of the country. Now, if you are an individual and you are constantly having to roll over your debt, meaning you have debt at a certain interest rate and you're going to consolidate it at a lower interest rate to reduce the amount of money that you're spending, and then periodically, rather than paying off debt, you're buying securities because they pay a higher yield, you are in a position that is not necessarily good. Now, in my program, Debt Management Secrets or Debt Management Plan, we talk about how you have to understand your cost of capital. So your cost of debt, your cost of capital, how much does it cost for you to raise the cash that you need in order to take care of day-to-day operations, to take care of day-to-day activities. Now, I know I talk about your personal finances as if you're running a business, but that's the right way of doing it, because a business, an independent entity, can make decisions that allow you to overcome inflation, that overcome changes in the economy. So the Federal Reserve, on their website, Federal Reserve Bank of St. Louis, has an article in March 2021 about how the national debt is an impact on inflation. So does raising national debt perpend raising inflation? And they talk about how they're structuring their investment in the U.S. government, in printing of money, in zero interest securities, which is actually what they call currency, and in describing it as a manner of revenue generation. So the Federal Reserve is an independent entity. They can print money and loan it to the federal government. They can buy the securities of the federal government, which is a form of investing or a form of making cash available. So if you have your company, you could sell stock in the company. You could sell shares or equity in the company in order to raise money. So that's what the Federal Reserve is doing with the U.S. government. And it shows over time how they buy the different securities, the no interest securities, which is currency. They buy treasury bonds, but they're also buying equities, and they're doing it in order to keep their lending rates down. So the Federal Reserve Bank lends money to large banks or in general the population through the banking system, and then they're buying back with the money that they've recovered, buying back debt and structure. It's a very difficult situation to be in. And what happens is they come up with this official inflation rate of about 2% since 2012. But it's actually very convoluted, because they're buying back U.S. treasuries. They're buying stocks and bonds. They're buying debt. They're creating debt by lending money out. Are you going to trust them with a central bank cryptocurrency? What's interesting is that they talk about this target inflation rate. Okay, so the money has to grow, costs have to go up, because they're printing and putting money into the economy. And if there isn't a inflation rate, which inflation is the interest they are receiving on the money they put into the economy, then Federal Reserve's not growing. So the Federal Reserve in application is no different than a business in application. If they don't keep raising their prices, their profits will not grow. Now, this is a huge problem, because inflation costs everybody. It costs the government, it costs businesses, it costs the wealthy, it costs everybody because prices go up. While prices are going up, the buying power of your money is going down. So let's say you've got $3 million in the bank. You are preparing for retirement. You've got your nest egg in the bank, and you've been saving all your life for this. That $3 million, following the rule of 40,000 per every million, should be able to spin off with minimal risk $120,000 a year. Now, you're going to pay taxes on that. And depending on where you live in the country, it may not actually pay any of your bills. Now, the propaganda side of this is the financial advisor saying, oh, well, you can use 4% of your principal every year. So the money's going to earn 4% and you're going to use 4% of your principal. That's going to give you $240,000 a year. Boy, are you in a good situation. Well, if you're paying 30% of that in taxes and you are having an increased cost of living, that $240,000 could be equivalent to $120,000. That $120,000 could be equivalent to $60,000. And if you're used to living on $100,000 a year, the net of this is going to be significantly less. Now, what do we do about this? First thing, I want you to learn about economics. I want you to learn about finance, and I want you to apply it in your daily life or in your household as if your household is a business. You're going to make business decisions. Now, if you've got $30 million in the bank or $20 million in the bank, you might have already started working with a family office. You might already have set up with multiple family units, some kind of shared or pooled resources. I met a gentleman that I actually worked with for a little while, and he was managing a family trust that had about $12 to $13 million in it. And in the 2008 crash, he was able to double that money because they were able to make smart and strategic decisions. Now, simply the fact that he had to make a convincing argument about investment decisions to an uncle, his mom, and other family members, it made these decisions better, and he was able to get better results. Now, whether you're pooling family resources or money, or you have a business that's pooling the interests of your stakeholders, the decisions you make have to do with accessing capital at the lowest cost possible, fixing that rate of capital. So you borrow money from the bank to build a building, you borrow money from the bank to do an investment, fixing that at the lowest rate. Then having customers. See, the Federal Reserve has the U.S. government as a customer and has all the large national banks as a customer. Now, they have small banks too as a customer, but their transaction value of a small bank is not enough to really be concerned about. So you can have this additional income coming in. So you have this family business. Whether the family business is two people going out and working or one person going out and working and someone taking care of the household, you're functioning like a business. You're using the money as a measure to know whether or not you're moving in the right direction. So this is why we look at free net cash flow here. So if your household is going in the right direction, they are buying the debt of corporations through investing in bonds. They are investing in the stock market. They are buying land. Could be the land that you live on, or you could choose to live what we call intentional thrift and then take that money and buy houses that you're renting out, cash flow properties. It could be buying cash flow assets like equipment. It really depends on what your area of specialty is, what your skills and talent can be. You might be creating intellectual property. So you have an expertise in a particular area. You're creating books, reports, and materials that you're then selling, whether it's on Amazon or you're selling it out in the general market. You could be speaking for trade associations in your business area. That functions both to promote you as an expert in that field, which gives you better employment opportunities, could give you consulting assignments, but otherwise is allowing you to bring in additional income. Now, the Federal Reserve brings in additional income by basically creating money. They just print some more money. Now, that has a negative impact on their customer who's receiving the money and then putting it into the economy. Now, if you're the kind of person that says the Federal Reserve is evil, you're missing the point. It's the Federal Reserve is creating funds for a customer, which is the U.S. government, and the U.S. government is making bad decisions about the money, just like you can make bad decisions about your money. I've seen a lot of clients that have super high incomes and they have no cash flow, meaning they spend everything they've got. They're servicing debt. So they say, well, where did all the money go? And I should point to them. It's in their house. The money is in this McMansion they've got. It's in the closets full of clothing they've got. It's in the shoe collection they have. It's in the over-the-top appliances and kitchens they don't even use. It's in the vacations. And you didn't lose the money. You just converted the money into something else, but that something else over time doesn't serve your interests. So what we're looking at here is you have to understand that there's no one contributing factor to inflation. There's no one bad decision someone made. There's no, it's not on purpose necessarily. It is a runaway activity that is not performing. So you need to know what types of things you must do in order to increase your income faster than inflation. So as the dollar loses value and it has less and less buying power, how do you increase the number of dollars that you have? When it comes to assets, what kinds of assets resist inflationary pressure by increasing in value, meaning they have greater demand during inflation? Now, there's some of the things you can do to beat inflation. You can buy equities. So there are different stocks and different sectors that will increase in value, not because they're worth more, but because the dollars have lost value and they're able to get dollars faster. So that's commodities, that's fixed income areas where they have got inflation adjustment investments. You might start your own business or have your own business where you can increase your prices. I have rental properties, and when inflation comes, I can increase the rent. Now, I can't always increase the rent because sometimes the tenant is in there, but ultimately I have the opportunity to increase the rent. I know a lot of business owners that have the opportunity to increase their prices. Building contractors, they got hit because their raw materials price has gone up, but they are able to do cost plus on their contracts. So it doesn't matter how high their material costs go, the customer's paying for it. They still get their fixed margin. They get a margin on everything. So they still grow. There's a lot of things that you can do. The biggest thing, again, is to understand economics. There are plenty of great books out there. We recommend some at the Sustainable Wealth Secrets website. You want to understand finance. How does the money flow through not only your hands, you've earned the money through a job or you've earned the money through customer service, and where does the money go? How does it flow through your system, and how much are you able to retain? And then when you do retain that money, where does it live and continue to work with you? If you could lock in high interest rates for cash-related accounts, could be certificates of deposit. It could be certain bonds. Maybe you're buying direct municipal bonds. Maybe you're buying direct federal treasuries. Understand, though, that there are new risks as inflation comes because, again, everybody's prices are going up. You have to understand that this is an action and response, and sometimes the response goes in the wrong direction. Just like I mentioned earlier, if you're constantly rolling over debt yet not paying any of it off, then you're not reducing your liabilities. You're basically putting your liabilities in a different place. And then if you have low interest, let's say you have a bunch of mortgages and you have no other debt, because you got a 5% mortgage, but in the market you're making 10%. Yeah, you can pay interest to have the money that's tied up in the house so that you have free net cash flow to put into investments. But there is a point you might as well just pay it all off and then have the upside to buy a new asset that cash flows and then pay a low interest on that. There was a point in the 1970s where there were like 10% mortgages and 15% mortgages. I remember in the 80s and 90s, I had certificates of deposit. They were paying me 7%. Okay. It goes up it goes down. The economy improves, the economy weakens. Now, there's no one source making this happen, so you've got to think about your personal finances as a business and be actually projecting, where should the money be in 2 years? Where should the money be in 10 years? If I spend this dollar now, how do I make it come back to me? Well, if you're spending money, you're pushing money away. How do we circulate this money within our economy? Because again, you can have geographic variations when it comes to the economy. How do we circulate this money so it comes back to me stronger? So there's a mindset element as well. So again, I want you to go visit the Federal Reserve website and read the articles there. There are no secrets today, by the way. Maybe in the 70s there were secrets because you had to go find the resources and read the reports. But today with the internet, there are no secrets. But you can search and you can read and you can educate yourself for years and not do anything. So I want you to have a good blend of doing something. Does your family sit down and talk about finances at least once a month? Not just talk about the bills, but how do we gain additional net cash flow? Your kids are talking about having cell phones. They're like, oh, I got to have a cell phone. All my friends have cell phones. Well, your friends are paying their own bills. Your kid can pay for their own cell phone. But getting involved in understanding how money works makes it easier for you to do what is right as far as your finances is concerned, even if it means that you don't have the things that the rest of the people have. I know people who are sitting on $20 million, $30 million. They didn't live a lavish life coming through. Now, they did have vacations. They did have family gatherings. They did more stuff in their community. They did a lot of staycations. But ultimately, they had a very enjoyable life. Now, they're 70, 80 years old, and they have more money than they're going to be able to spend in their lifetime. So they now can be a blessing to their family. They can be a blessing to charitable organizations. They can be a blessing to pass on the knowledge and information. That's, in fact, how I learn a lot of these things. I talk to older people. I talk to people that have gained wealth. I talk to people who are running successful businesses, and I just take notes. And I understand that these methods are universal. I also look at historical activities and historical trends when it comes to inflation and wealth building. I hope that I'm able to deliver these things to you in a hearable format. I know I'm not that entertaining, and sometimes I cause anxiety in my listener, but I sincerely want to hear your successes. I sincerely want you to grow not only the wealth, because again, money being a medium of exchange, your wealth becomes a stored security into your own future. So if you're able to have free net cash flow, invest that in assets that cash flow, you're going to be growing the cash flow. As the cash flow keeps growing, if you can maintain a larger and larger free net cash flow, meaning the money that's left over, not only do you put money aside up front, but you want to have money left over at the end, you can then continue to stack that. And if you know the numbers, you can outpace inflation. Not only outpace inflation, but when the economy improves, you could be ahead of the game. See, the measure of success is not a good economy. When I was doing the .com stuff and people were cutting me $30,000 checks for like 3 or 4 hours of work to do something technology-wise, that goes away. So your success is actually measured by the worst economy, the worst levels of inflation, the worst conditions, because the same methods work. I'm Justin Hitt with Sustainable Wealth Secrets. Visit us at www.sustainablewealthsecrets.com. No spaces, no dashes, just 3 words put together, sustainablewealthsecrets.com, where we have a number of resources that help you beat inflation, that help you grow wealth, that help you manage your bottom line to create results that will be available to you and your family for generations. I want you to have financial security. I want you to have money that grows, but I also want you to have the other forms of capital that make a life worth living. If you have any questions, write into our offices. I prefer to get a fax or a letter, and then we'll answer those questions on a podcast, or I'll send you some materials. I want to thank you for listening. If you're listening to this on Apple Podcasts or Google Play or Spotify, be sure to like and subscribe. That's how I know how many people are listening and enjoying what we have here. But don't just enjoy it. Go out and use it. You can beat inflation. You can start understanding how the system works. Once you understand how the system works, then you can work the system. That's really what it's about. That's how you sustain wealth. Whether the economy is good or bad, I'm looking forward to your success. Thanks for listening.